If you are looking for financial nirvana or you are looking for financial success in your life, then this video can be a game changer video for you. In this video, I'm going to give you some simple hacks and insights which can help you in your financial journey and can push you to all together different financial level. Hello everyone, I'm Shobit. I'm a FinBiz growth expert and founder of FinBiz Growth Club. We are an aspiring community of new age mutual fund distributors who are determined to change how India invests. So let's talk about the first and most important thing which you need to keep in mind when you are planning your financial journey or you want to be financially secure. The first thing which we need to remember, my dear friends, that we need to first concentrate on savings before diving into investments. What I mean by that, most of us are so preoccupied with the notion that they want to invest in best stock, best mutual fund, best asset classes that we often forget that the wealth building process starts with savings. Now let me give you the details. Now what are the factors which is going to help you in getting the outcome from any investments? As I see is there are three factors. First is the quantum of money which you are going to put. Second is the time period for which you are going to invest. And third is the return which the assets or the instrument is going to generate. Now, look at all these three aspects. What is in our hand as an investor? In our hand, it is not the return, because that return is either going to be governed by the asset in which I am investing or the fund manager who is managing that investment. But the thing which is in our control is the quantum of money which I can invest and the time period for which I can invest. But most of us are so much preoccupied with the notion that they want to invest in those vehicles, those assets, those instruments which is going to give me highest return, that they often forget that even if you get 100% return in 1,000 rupees investment, it is still going to be 2,000, not 2 lakhs. So what we need to understand, the journey should start with first start accumulating enough corpus so that I can generate enough return on those corpus which is going to make meaningful change in our financial life. So I want you guys to start with the habit of savings before going into those nitty-gritties. So I hope you guys are clear. Other thing which you need to be keeping in mind regarding savings and investments is, if you don't have enough corpus or savings in your bank account or in any investments from where you will be able to withdraw within 24 hours of notice, then you will not be able to continue those investment journey for the desired period of time. Now let me explain this. Now let's assume that you are only having, say, 10,000 rupees in a bank account and you are start doing your investments. Or if you don't have enough cash in your bank account and you start your investment journey. Now we are all know that we are going to have lot of expenses happening in our life for which we have not planned for. It is going to happen day in and day out. And if you don't have enough cash in your bank account, then you are going to withdraw your investments. In that case, it is neither going to help you in any way possible. So you need to understand that savings should be first and then the investment journey should start. And as I told you, money, time and return, and money and time is under your control. So this is the first thing which you need to keep in mind. The other thing which you need to keep in mind is the biggest return which you can get from any investment is in your human capital. Now, most of the time I have seen a lot of people putting a lot of time even in their office work hour on looking at trading terminal, looking at stocks and so on and so forth. But as I told you, the biggest wealth creation will start if you have enough savings. And the enough savings will only come when you are able to grow in your professional life. So you need to be understanding the biggest return which you are going to generate. It is when you are going to invest in yourself. Instead of trading for various hours, if you are going to invest in your craft, you are going to grow in your professional or corporate life, and that is going to reward handsomely in generating enough cash flow, which is in turn is going to be converted into enough wealth creation. So what you need to understand, that lot of effort, lot of emphasis should be given to invest in your human capital, which is going to reward you the biggest return of your life. Now, the third is portfolio diversification. Now, if you are going to put all your money into only one asset class by looking at only the returns of it, it is not going to help you. We need to understand that 90% return of your portfolio is going to be because of the asset allocation or portfolio diversification. So you need to have equities, you need to have debt, you need to have gold, you need to have real estate, you need to have foreign investments. Anything which can help you in diversifying your portfolio in a meaningful manner, you need to do that. And this diversification should happen depending upon various technical and quantitative numbers. So first thing, the income which you have. Second thing, the liabilities which you have. Third thing, at what age you are in. And let me explain this. Now, if you are having an income of say XYZ and it is not a substantial income, let's assume that you are going to be investing, let's assume 10,000 rupees per month, and you are going to choose say 10 funds in 10 asset classes, it is not going to work. It is over diversification and it is not going to help you in optimizing return of your portfolio. What you need to understand, you need to have a qualitative diversification of your portfolio depending upon the income or depending upon the money which you are going to be investing. Second thing is, what is your liability? This means if you are having lot of EMIs, if you have lot of debts, then it should not be that you are going to put in riskier asset classes assuming that it is going to give you enough returns and you will be able to fulfill your debts. This is a wrong premise for your investment journey. The more liabilities you have, the more safer you need to play in your investment journey. And of course, age is also going to play a very vital role. Now, we have a lot of thumb rules, but if you're going to follow thumb rules of 100 minus age is equity investments, then I think it is a very wrong premise, because we are not considering your income, we are not considering your liabilities, and that can boomerang in your investment journey. So please understand that diversification should be also done. Don't chase the return every time. The fourth thing which I want you guys to understand and work out is, you need to understand that you need to protect the interest of your family before you dive into investments, because investments are always risky. So you should have your life insurance, you should have your medical insurance, so that unexpected expenses are going to be taken care of. If you don't have enough protection, all your investment journey is going to be at a huge risk. Now, the last insight which I would like to share with you is, most of the time you are going to find in a lot of platforms that we need to reduce the cost of our investments. We need to invest in those vehicles which is going to give you minimum expenses, because that is going to help you in getting your returns much higher. To a certain extent, this argument is true. But you need to understand, my dear friends, that there is a huge difference between investment return and investor return. Most of the investors are going to start their investment journey by seeing the investment returns, but they are never get the investment returns replicated in their own investment journey, or in other words, their investor returns are going to be hugely different from what the investments has delivered. And there can be multiple reasons. There can be a reason of taxation, there can be a reason of emotional roller coaster which a customer goes. Let's assume that today market crashes by 50%. What are you going to do? How you are going to manage your emotions? And most of the time we have found that people are not able to control their emotional uphills without any external support. So what you need to understand is, even though you will be able to save 0.5%, 1%, and whatever that percentage may be, in a shorter period of time. But if you are not able to continue this investment journey for a desired period of time, you will not be able to get a desired result, and that cost would be much higher than what you are going to pay to a professional financial advisor to meet your financial goals. So don't look at those numbers which say in 25 years, 30 years, 35 years, you are going to save this much. The question which you need to ask yourself is, will you able to take prudent financial investment decisions on your own for such a longer period of time? And if you are not sure on that, then I would highly recommend that you need to take a professional approach to your investment journey. So I hope I have simplified the life for you in terms of how you need to approach your financial investment journey so that you can get a desired outcome from those investments which you are going to make. In case you like the content, I would love you guys to hit that thumbs up button, subscribe to our channel so that whenever we have something new to offer, you guys will be first one to know. Thanks for watching. I'm going to see you next time.